It's now been more than 2 full days, almost 3, since the Bank of International Settlements quarterly review came out with the 4 pages of the 154-page report, starting really on page 21, I think going to page 24, if you want to search through there and read it for yourself, where they talk about their theories of why the repo market on September 16th and 17th started to go haywire. So Zero Hedge has had a number of articles come out in the last day or two, including from this repo market expert named Zoltan, who used to work at the New York Federal Reserve and actually helped the TALF program and helped the New York Fed redesign the repo market during the 2008 financial crisis. He also worked at the US Treasury, and then he left for a private sector job at Credit Suisse. So that article came out today on Tuesday. But they released an article yesterday talking about how there was potentially, this was citing the Bank of International Settlements report, talking about how there was multiple long-term capital managements. And if you're not familiar with the history of long-term capital managements, I'll talk about it very briefly. So it was a bunch of geniuses, a bunch of egghead PhDs. There's a book by Roger Lowenstein called When Genius Failed. I have not read it, but it has an enormous amount of 5-star reviews on Amazon and Audible, over 400. When Genius Failed, The Rise and Fall of Long-Term Capital Management. Jim Rickards was also the lawyer at Long-Term Capital Management, so he's discussed this in his book. He knows a lot about the ins and outs of the bailout for long-term capital management, how Bear Stearns didn't participate, even though they were asked to, and a bunch of other interesting details. But long-term capital management was actually a very successful hedge fund for a few years. It made enormous returns. I was looking up the returns. The first year was over 20%. The second year was 40% or around 40%. The third year was around 40%. And in the fourth and fifth years is when things started to get dicey. They used an insane amount of leverage to make bets on bonds. They had, I believe, $3 billion worth of equity, and they leveraged that up for leveraged currency bets and leveraged bets on bonds during the Asian tiger crisis and also in Russian bonds when the ruble was falling. And I believe that some of their trades were over 100-to-1 leverage. So this was hedge funds taking too much leverage, taking too much risk, making bad gambles in currency trades, leverage trades, and also in options trades, and also bonds. Leveraging up bonds. So they didn't just buy bonds. They borrowed money to leverage up the bond trade. And this takes me to Ray Dalio's risk parity trade. So Eric Townsend, who runs the Macro Voices podcast, if you go into the archives of my YouTube channel, I've interviewed Eric a number of times in the last year and a half, and asked him about the risk parity trade, what it was. If you're not familiar with what it is, I'll just give a very brief summary. It's where hedge fund managers or professional institutional investors, normally hedge funds, because Ray Dalio founded it and a lot of hedge fund managers have copied it, where they bet that stocks and bonds cannot drop at the same time. And so what they do then to increase their returns is they buy leverage, they use leverage to buy bonds. So they're leveraging up because normally bonds in general don't produce a lot of capital gains, although now the craziness that the central bankers are doing, it is, because people now are buying in this upside down world, dystopian, bizarro world, Twilight Zone world we live in. People are now buying stocks for safe dividends and bonds for capital gains. And for over 100 years of finance, it's normally been the exact opposite. So this risk parity trade could be tied in with what is going on in the repo market. And also I'll talk about the 10-year US Treasury moving. I've been doing a little bit of financial detective work too, and I found a couple interesting stories in the last 10 days about Bridgewater, about Ray Dalio's firm. Now, he doesn't run the firm anymore. He's more of the chairman of the board, spokesperson. He's writing his book. He wrote one book. He's talking about writing another. He's writing these articles. He's doing speeches. He's trying to get a high-ranking job at the World Bank or the IMF. Those are the rumors. So he's hobnobbing it. He's been Mr. Big Davos speaker guy for a very long time. So there's some anecdotal evidence, and I'll talk about the ties in a little bit. No one else has brought this up. I just read the Zero Hedge articles where it may also be Bridgewater that is in trouble with the repo. And I'll talk about why with some of the connections. Also, the co-CEO of Bridgewater, number one, Bridgewater is having a very down year, and they've made bad bets on bonds and interest rates, especially different global interest rates, which means that they've been doing, leverage spread trades and leverage bond trades, but also with the ties to, and I'll talk about that in one of the articles in a little bit. So, these articles are talking about long-term capital management blew up because when they use 100-to-1 leverage, all it takes is a 1% drop in the value of the assets they bought on leverage for them to get blown out. And so they had a bunch of these trades, and their total leverage at the firm, because they had $3 billion in equity and they had over $100 billion in loans outstanding. So they had they were leveraged more than 30-to-1. So all it took was barely a 3% drop in asset prices of across the board of their portfolio for the firm to blow up. So it was very predictable that long-term capital management would blow up. They kept doubling down on trades and adding more and more leverage. And for a while it worked, and then it blew up. And then the large Wall Street investment banks came in, and the Fed had to step in and bail out long-term capital management. And we may have similar to that soon with larger hedge funds and the repo market. The Zoltan guy wrote in his newsletter that he thinks this is heading towards an even larger QE program, potentially before the year is over. Now, there is the Fed meeting supposedly going on soon. So, not sure if they announce anything now, but Zoltan thinks that there will be another QE program, a larger QE program. But he's not considering what's happening right now, this not QE. He doesn't consider there's Wall Street semantics going on with a bunch of these professional Wall Street financial professionals, that it is not QE, even though it is QE, because it's expanding the balance sheet. They're trying to increase reserves. So these two articles that I have there on the screen, one of them is talking about JP Morgan. And JP Morgan was heavily involved in the repo market. They were the four large U.S. banks are some of the main lenders in the repo market. Also, Bank of New York Mellon. I've talked about this. Bank of New York Mellon is heavily involved in the repo market now. That JP Morgan sold part of the business like 3 years ago, 2017 or 18. They sold part of the repo business to Bank of New York Mellon as a custodian, and that part of the repo business was not making much money initially. And Bank of New York Mellon proudly states on their website that they've grown that part of the repo market to where they take money market depositor money and then loan it to hedge funds that are leveraging up on these bond trades or other trades, where they've grown the size of that repo market to $100 billion per month. And now they're making a bunch of fees off that. And I'll explain with connecting the dots that I've connected the dots. I've learned other people with this. My theory that I've come up with in the afternoon and the financial footprints that connects this to Bridgewater, which is Ray Dalio's firm that he founded. He does not run Bridgewater anymore, but they use a lot of his investing principles. He wrote an entire book on business and management principles, and I'm sure they're still using this risk parity trade. But Eric Townsend of Macro Voices has been predicting for over a year now that this risk parity trade would eventually blow up. And we've had a lot of volatility in bond prices, especially the 10-year Treasury. The 10-year Treasury, for volatility, just for some perspective here, on October 1st of 2018, the 10-year US Treasury yield was 3.225%, and then it started going down a lot. And by the time, really, towards the end of 2018, early 2019, you had Stanley Druckenmiller come out and say that he was long treasuries, that he was betting on zero interest rate policy, and then a bunch of, in my opinion, hedge funds copied Stanley Druckenmiller on that trade, and they leveraged up the trade. So they leveraged this trade. Maybe they leveraged it more than 10x. And they bet that the 10-year US Treasury yield was going a lot lower. And for a while, they were right. So the trade went from around when Stanley Druckenmiller talked about it publicly, I think it was February. So it went from around 2.755% yield on the 10-year US Treasury. It went all the way down to 1.45%. Let's see here, it was September. I believe it was the beginning of September. Let me change the chart here. I'm looking at the chart. So it got to 1.45% on September 4th of 2019. So that trade was very, very profitable, but we had a very big spike from September 4th, and the yields rocketed higher to 1.9% before it rallied back, before the yields went back down. The yields in only about 10 days on September 13th went up to 1.9%. So very big spike. I think this is the fact that a lot of these hedge funds were very leveraged holding these treasuries, long treasuries, and also these repo problems started before they became public. So I think the repo problems were involved with these hedge funds gambling on the 10-year US Treasury. And that big spike, now that we're in hindsight and more of this information is coming out with the Bank of International Settlements report and them talking about how hedge funds have over-leveraged in the repo market, and they're worried about that. And they're also talking about dollar forward swaps, which is something that there's an enormous amount of dollar forward swaps, and they've exploded in the last 3 years or so. In just the last 3 or 4 years, China's doing a massive amount of them because they don't want to sell all of their reserves. They don't want to use all of their reserves, so they've been using derivatives to get more dollars that they're hoping they can buy. They can pay back the derivatives later, but they get access to those dollars now with the derivatives. So it looks to me like repo started a long time before it became public, and the 10-year US Treasury has had an enormous amount of volatility. So just in the last almost 18 months, it's been above 3%, and then it rocketed all the way down to 1.45, and now it's back up in only 3 months to 1.83%. So that's a lot of volatility, and that much volatility will really, really hurt a hedge fund that has gambled on the wrong direction of a bond or an interest payment, like what Bridgewater has done, supposedly, and why Bridgewater has been losing record amounts of money. I think Bridgewater, according to this article, Bridgewater... Okay, let me get... I have 2 Bridgewater articles. This one's from December 3rd, 2019 by Carmen Rinke. Ray Dalio's top fund is having a rough year, and now one of Asia's biggest lenders is telling clients to pull their money out. Ray Dalio he doesn't run the world's largest hedge fund anymore. He's not the CEO. His Pure Alpha, Bridgewater's top fund, Pure Alpha, fell 6% through August 23rd, while other similar funds paired gains. The fund's underperformance and Dalio's public comments were main reasons that this bank pulled money, recommended to clients that money get pulled out. The fund lost 6% this year through August 23rd, Bloomberg reported, driven by bearish bets on global interest rates. So you should be able to look up some of these holdings in the 13Fs from hedge funds. I think Insider Monkey covers a lot of this. The website, I think they cover a decent amount of this for free. If you have a Bloomberg terminal, I think you can also look it up. But there has been bearish bets on global interest rates, and normally hedge funds use leverage. So the other interesting thing, besides all this volatility on the 10-year Treasury, and this volatility will hurt any hedge fund that borrowed in repo, leveraged up the trade a lot, and gambled on bonds with leverage, a lot of leverage, and made a bad directional bet, didn't hedge. Because we know hedge funds now, I've said this all the time, a lot of hedge funds don't hedge. They use leverage and make a one-way bet and then don't hedge. Most hedge funds do not hedge anymore. Okay, so the other thing that connects it, and this is my financial detective work here, is the same day on Tuesday, December 3rd, that it came out publicly, that Bridgewater lost a enormous percentage gains, some of the worst in company history in the fund, is the co-CEO, Eileen Murray, is leaving. She was fired and she's gone. So that was less than 10 days ago. She had been at the fund for more than a decade, co-CEO since 2013, one of the highest ranking women in hedge fund industry. And what's interesting about this is the time she's leaving. So the amount of the losses came out, the repo stuff is coming out. And then here's the interesting part in the CNBC article. While at Bridgewater, Murray headed partnerships with Bank of New York Mellon and Northern Trust, who oversaw Bridgewater's long-term real estate fulfillment strategy and started the firm's diversity and inclusion council, among other things. But what's interesting about Bank of New York Mellon and Bridgewater is that Bank of New York Mellon is pushing their repo, hedge funds into repo. Hey, you can take these, they're the middleman. Bank of New York Mellon is the middleman. And the money markets need a higher returns. And we're going to be the middleman as Bank of New York Mellon. And we're going to get more hedge funds to borrow here in our private repo, tri-party repo market. So hedge funds borrow, and the Bank of New York Mellon is the middleman. They borrow essentially your savings in money market funds if you own money market funds. I hope you don't own money market funds, but a lot of regular Americans do. And money market funds are not supposed to be gambling on this stuff. And then you add in a bunch of leverage and not hedging, not really hedging, but these hedge funds are making very highly leveraged one-way bets, and boom. All it takes is some volatility in bond yields, and you got a problem. Depending upon the leverage ratio. If you're leveraged 30 to 1, like long-term capital management's entire firm was on all their capital, or 100 to up to 100 to 1 on some of the trades that long-term capital management was doing, it does not take a lot to blow up a trade or wipe out your entire firm's capital. So I'm not saying Bridgewater is going to go bankrupt, but I'm saying there's anecdotal evidence here. There's definitely, it's an interesting theory that Bridgewater is having repo problems because they have a relationship with Bank of New York Mellon, and Bank of New York Mellon is pushing their repo market growth hard to hedge funds. But the article did not specifically mention that. I have not seen that mentioned anywhere else. I just thought it was interesting because after I found out from the McIlvaney Weekly Commentary about Bank of New York Mellon's involvement, because I haven't seen many other articles talking about it, even though it's mentioned all over Bank of New York Mellon's website, bragging about how good they are at growing their repo business. So I think there's more than just anecdotal, probably more than just anecdotal evidence and circumstantial evidence there. Someone would have to do some more investigations. Okay, let me get to this Zoltan article. Oh, the other thing about JP Morgan. Let me talk about JP Morgan. So JP Morgan culminated with this article from Monday. The Fed was suddenly facing multiple LTCMs. Bank of International Settlements offers a stunning explanation of what really happened on Repocalypse Day. They're naming JP Morgan specifically as also causing problems because JP Morgan's balance sheet, they're a very large bank. Their balance sheet has been changing drastically in just the last couple months, and I'll talk about the details in the article. So JP Morgan has drained liquidity from money markets and reserves parked at the Fed, may have prompted the September repo crisis and sudden launch of not QE by the Fed in order to reduce its risk, its at-risk capital, and potentially lower its G-SIB charge, currently the highest of all major U.S. banks. Shortly thereafter, the Financial Times reported with confirmation that the biggest U.S. bank, JP Morgan, has been quietly rotating out of cash, so they don't have as much cash balances on their main bank balance sheet or as reserves at the Fed, while repositioning its balance sheet in a major way, pushing more than $130 billion of excess cash away from reserves, in the process significantly tightening overall liquidity in the interbank market. We learned that the bulk of this money was allocated to long-dated bonds while cutting the amount of loans it holds in what the Financial Times dubbed was a major shift in how the largest U.S. bank by assets manages its enormous balance sheet. The moves saw the bank's bond portfolio soar by 50% in a very short amount of time, and were prompted by capital rules that treated loans as riskier than bonds. And since JP Morgan has been aggressively returning billions of dollars to shareholders in dividends and share buybacks each year, JP Morgan had far less room than most rivals to hold riskier assets, explaining its substantially higher G-SIB surcharge, which indicated that the Fed currently perceives JP Morgan as the riskiest U.S. bank for a variety of reasons. An executive at a large institutional investor told the Financial Times that what JP Morgan did is incredible, adding that the scale of what JP Morgan is doing is mind-boggling, migrating out of cash into securities while loans are flat in such a short amount of time. The dramatic change, which occurred gradually over 1 year and which may have catalyzed the spike in repo rates in September, was first flagged by JP Morgan at an investor event back in February. Then CFO Marianne Lake said that after years of industry-leading loan growth, we have to recognize the reality of the capital regime that we're in. About half a year later, the rest of the world did too, when the overnight general collateral rate briefly did something nobody had ever expected it to do, when it exploded from 2% to about 10% in minutes. So that was the Tuesday night, September 16th repo spike. The other interesting thing about JP Morgan that Zoltan, I think, is talking about in his article, switching back to the Zoltan article, is that it seems that JP Morgan was betting on the Fed was going to do larger not QE than $60 billion per month, and they were hoping that the Fed, that they would be able to sell a lot of those treasuries back to the Fed now that interest on excess reserves has been lowered, that they were going to be able to sell those treasuries back to the Fed at a profit. And that has not happened. So we have a number of things that could have helped trigger this repo crisis. We have big volatility in the 10-year US Treasury, enormous volatility just in the last 1 year plus since October 2018. We have a lot of leverage that the hedge funds have used, and the leverage is what got long-term capital management in trouble. And then we have Bank of New York Mellon pushing these hedge funds to borrow more from the repo market and taking savings that is not supposed to be gambled with in the money market funds and letting hedge funds leverage it up massively and gamble with it. And then we have JP Morgan betting, increasing massively the amount of long-dated US Treasuries they own, reducing their cash amount, not having as much liquidity and cash available for the repo market, and betting that the Fed would have had a larger not QE program. And so this is why Zoltan says that, in his opinion, the Fed needs to introduce a larger QE program. And it also looks like this risk parity trade, not risk volatility trade. I was thinking of the leverage volatility trade with Christopher Cole. This is the risk parity trade. This risk parity trade that Bridgewater, Ray Dalio and Bridgewater are so famous for could really be hurting them now. And it's not just them. There are a lot of financial professionals and hedge funds that have copied Ray Dalio and Bridgewater on this risk parity trade. What would cause the risk parity trade to get in trouble would be if there's too much volatility in bond prices, especially if they're using a lot of leverage holding the bonds and they're not hedged, and if stocks and bonds went down at the same time. So it only takes a couple different things for this risk parity trade with the amount of leverage to blow up, to cause damage. So the repo market is where these hedge funds borrowed so they could leverage up more and then do the risk parity trade. So it's leverage on top of leverage. And if this is long-term capital management, the leverage, if there is multiple long-term capital managements, the leverage is going to be more than 10x because long-term capital management had more than 10x leverage. So if you want to read up more on long-term capital management, there's the book by Roger Lowenstein, When Genius Failed, The Rise and Fall of Long-Term Capital Management. I also have a few articles. If you do not want to read an entire book or an audiobook, if you just want to learn about long-term capital management. But what gets these hedge funds in trouble is, number one, leverage. Too much leverage. Number two, they make a bad bet in the wrong direction and they're not hedged. Happens all the time. Normally, it's not on this scale, though, with long-term capital management. When hedge funds blow up, though, they're normally smaller guys. Someone wants me to explain the Zoltan article in easier to understand terms. Okay. The core problem at the heart of the repo blockage is the bank shifted from owning reserves to collateral, mostly treasuries, for reasons they will address. The article addresses shortly. Large U.S. banks like J.P. Morgan that are central to year-end flows spent some $350 billion of excess reserves on treasuries since the beginning of the Fed's balance sheet taper. So what he is saying is they reduced their amount of... So quantitative tightening also reduced reserves. Quantitative tightening reduced the money supply. It pulled reserves out of the system. And then on top of that, the banks also started pulling their reserves and betting on treasuries. So you had all these counterparties in the repo market, and you had the market makers for the repo, the custodians of the repo market, who are supposed to have ample liquidity to handle these repo transactions, and they were pulling liquidity out to gamble on treasuries, probably with leverage. So they spent $350 billion, according to Zoltar, on excess reserves on collateral since the beginning of the Fed's balance sheet taper, leaving banks, and especially J.P. Morgan, dangerously low on reserves. And while one can debate why banks shifted away from reserves to collateral, Zoltan Pozar, I guess that's how I pronounce his last name, has a simple theory. Dealers and banks loaded up on collateral as a trade. So by him saying collateral as a trade, they were betting... Risk parity, the banks didn't do risk parity, it was hedge funds. Bridgewater and Dalio are famous for risk parity. Okay, dealers and banks loaded up on collateral as a trade that was supposed to be taken out of by an eventual purchase by the Fed. So the banks, the large banks like J.P. Morgan, as a trade, tried to front run the Fed starting QE again, ending quantitative tightening and starting bond buying purchases. And it has not worked because the Fed is not buying as many treasuries as the banks bought. In other words, a former Fed official, Zoltan's a former Fed official, admitting that banks were purchasing treasuries as nothing more than a QE front-running ploy, something which the Fed had previously sworn was never the intention behind QE. Finally, central bank liquidity is useless unless primary dealers have balance sheets to pass it on, and that they've been passing it on since September does not mean they will by year-end. Well, I disagree with him about year-end. But a lot of these primary dealers are not large banks. A lot of these primary dealers are smaller Wall Street trading houses, smaller securities brokerages, and they cannot meet, if the US Treasury is selling a lot of treasuries, they cannot meet all of their obligations to buy a lot of treasuries. So they have to either buy the treasuries and sell them to someone else, or they're stuck with the treasuries. And so some of these primary dealers had to go into the repo market too to borrow money to buy treasuries. And this is something that the current Dallas Federal Reserve president has been saying. That the primary dealers, and not the large banks, but the other primary dealers were forced to buy treasuries and didn't have enough money. So they went into the repo market to borrow the money to buy treasuries that they were forced to contractually buy. Hey, Rob, I asked Eric Townsend, who is a hedge fund manager who talks about, the risk parity trade frequently, and he said it's mostly stocks and bonds, and it's leveraging up the bond trade. You can go look in the archives for my Eric Townsend interview on that. So if you disagree, you can email Eric Townsend. That's what he said. And he interviews hedge fund managers on Macro Voices almost every day now. Normally, bonds do not produce a lot of capital gains, so leverage is used to increase returns on bonds. And it's not really hedged at all because there's not a lot of downside protection. They're betting that stocks and bonds will both not fall simultaneously. That's what Eric Townsend said last time I interviewed him about risk parity. Thank you, RR, for the super chat. I appreciate it. Thank you, Justin, for the super chat. Thank you, Silver Stacker. He sent me a little weird emoji con there. It's like a pear thing doing arm curls. I appreciate the sticker, though. I don't think everyone can do a risk parity trade and be successful, just like everyone cannot do index funds and be successful, just like everyone cannot do the leverage short volatility trade and be successful, just like everyone cannot buy prior to 2008 real estate and be successful. For a while it looks good, and then eventually it just doesn't. No. Steve asks... Sorry, I didn't read Steve's question here. I just answered it. Jason, I read the Zero Hedge article. Do you think there's a crash coming days? No. Nope, because the Fed, what has been happening with repo is the banks that are borrowing in repo, and we don't know which banks are doing it. These articles seem to think it could be JP Morgan. But what is happening in repo is... instead of as much overnight repo, these banks are now switching to term repo. They're switching to 14-day, 42-day, and now 28-day term repos, which means that they can have the money loaned to them for longer periods of time. And the Fed claims that these repos will roll off the balance sheet, so they will not be added to the balance sheet. But we have evidence that the Fed's official balance sheet has increased a lot more since the end of August than the not QE program of $60 billion worth of bond buying per month. Which in my opinion means if the balance sheet is increasing and it's larger than the 2 months of not QE that we have, then some of these repos are hitting the balance sheet and they are not rolling off, as the Fed claims. So no, I do not think there is a crash coming in days. I think what the Fed will do is they could just increase the size of each term repo. They can offer more 14-day term repos, more 42-day term repos, more 28-day term repos, so they can increase the amount of each term repo and the size of each term repo. So they were only supposed to have a couple, I think, of these like 42-day term repos and 28-day term repos. They can increase the amount of them. The 14-day term repos, when they started, were smaller dollar amounts for the 14-day term repo loan. So the banks are switching from overnight repo loans. They're not... It was supposed to be at least $120 billion borrowed in overnight repo. But if you look at Jim Bianco's charts that are coming out, and... the most important thing I've seen about the repo market, besides the Jim Bianco charts, are what the New York Federal Reserve Vice President said in that speech on November 4th. That's on their website, because they count it on a per-day basis. So they add in the overnight repo with all the term repos outstanding. So the 14-day, now the 42-day, and the 20-day, they count all those together on a per-day basis. So people are like, oh, you can't say per day. Well, the New York Federal Reserve themselves uses per day, and they also had a chart in that speech, a really good chart that I had a screenshot of for another podcast. As soon as that I found that chart, thanks to David Quinteri of Money GPS. And they said in that chart that it's per day. So the per day repo and the Fed, by the way, at the end of October, it was 190 billion per day in repo. And we're way over that. We're way over that. Jim Bianco says it's over 300 billion now. And he thinks it could be over 500 billion in a couple weeks. But it's not all overnight repo. It's now what the banks are doing is they're not borrowing as much overnight, and they're moving a lot more of their borrowing into 14-day, 42-day, and 28-day term repos. Hello, Rob. I really don't care about the risk parity trade. I think it's a stupid way to allocate capital. I'm more of a fundamental analysis research person. I do a little bit of technical analysis, top down, bottom up, and then maybe I use some options with some hedging trades for leverage. These risk parity trades and the leverage short volatility trade, all these things, this extra leverage is what's going to eventually blow up. It's all the leverage. Because these hedge funds are doing risk parity with leverage. And it's not a little bit. Same thing with the leverage short volatility trade. Yeah, we really need an audit of the Fed, another audit of the Fed. It's not going to happen, though. And now, in this Bank of International Settlements report, they're talking about the European Central Bank in Europe, how they're having repo problems now, too. So you have repo problems in China. They're a lot smaller than the U.S. The U.S. repo problems have not been fixed. So the per day number, I'm using what the Fed said. I'm going to go by what the vice president of the New York Fed said in her speech. Oh, you mean like what John Paulson did? How he got to select all the subprime mortgage-backed securities to bet against from Goldman Sachs? So no, I don't think there will be a crisis in the next couple days. I think that's just clickbait. I think what the Fed will do is exactly what Jim Bianco has been saying, is they will just try to drug the repo market more and more into submission. And the talking heads on mainstream financial media, CNBS and Bloomberg, they're not going to care if it goes up to 500 billion per day in repo. As long as the stock market looks like it's going to go up, as long as the dollar looks okay, the CNBC people hope the gold price gets smashed so they don't have to talk about gold's doing well. Rick says the article is very, very scary. Yeah, I don't think we're gonna see a collapse in a couple days, because I think what the Fed's just gonna do, because they've gotten away with it. Look, I mean, there's hardly anyone that worried in financial professionals. A lot of mainstream financial professionals. Jim Bianco is one of the main ones, and they're already calling him names with the repo market. Most of the mainstream financial professionals are not worried at all about the repo market. It's all still China trade deal, China trade deal, China trade deal. That's the majority of the coverage all the time. They should be talking about the repo market. Instead, they're talking about China trade deal. Okay, I'll take a look at listener questions and comments, and then I'll wrap up the show. I'm glad you like my detective work, RR. I appreciate it. So, with the business relationships that the former co-CEO of Bridgewater negotiated with Bank of New York Mellon, I think it's likely that Bridgewater was very heavily involved in borrowing from the tri-party repo market. Rob says the Fed knows this above the law. I 100% agree. And you're not going to get a whistleblower from the Fed because there's Danielle DiMartino Booth disclosed this in public in interviews on Real Vision TV and other interviews that there's different top secret security clearance levels at the Fed. So if you're a whistleblower and you leak stuff, you're risking going to prison. So most stuff will not be leaked at the Fed, especially the really juicy stuff. Vision Fund impact. Well, they've made bad bets. People are pulling their money out. Ray Dalio's made some bad predictions, and they made some bad bets on interest rates. So there's people, and also at the Fed, there's people earning six-figure salaries, cushy jobs, very cushy jobs with Cadillac Healthcare and cushy retirement benefits. Also, discounted really good food at the cafeteria, supposedly. Not that they need it if they're making six figures, but they get it. And other perks. And if you're making six figures a year with those type of benefits, and you have a top secret security clearance, well, why would you leak? Why would you risk losing your career? There's not an incentive to leak. So I doubt we're going to have a whistleblower. Especially when these former Federal Reserve people, like Zoltar and there was another guy on Twitter who was calling Zoltar names because he said, how dare Zoltar ask for more QE? RR says, repo to infinity and beyond. The average person who doesn't know what the Federal Reserve is and only cares about their stock portfolio will not care. CNBC doesn't care. Bloomberg doesn't care. Maybe they'll cover this if you're lucky for a couple minutes. Maybe. Maybe there'll be an article. Maybe there'll be a 5-minute television interview and there'll be a bunch of nasty questions to the person who's warning about what's going on in repo. Do I think the Feds will lower rates tomorrow? They've uninverted the yield curve already, so I don't think they have to do that. The dollar also is not rapidly rising, so they wanted to uninvert the yield curve. That's why they did so many rate cuts very quickly, in my opinion, and also the dollar. Because the dollar and the dollar index and the trade-weighted dollar, you had the trade-weighted dollar a couple months ago was at all-time highs at 131, a little bit above 131. Trade-weighted dollar index, and the regular dollar index was at one point at 99, and once those rate cuts started, they got the dollar index back down. So now it's at 97.46. So no, I do not think that they will do a rate cut, but I would not be surprised. I'm not doing any trades on that stuff. I honestly don't really care that much. So no, I don't think there's any hurry to do another rate cut right now because the Fed's not going to come out and say publicly that they wanted to uninvert the yield curve and that they wanted to get the dollar down, although Trump wants a lower dollar. Trump and the US Treasury, they want a controlled devaluation of the dollar. Well, thank you, Edward. I appreciate it for the super chat. It's Finance Freak says banks holding the world hostage. It's not just banks, Finance Freak. It's these large hedge funds, too. It's the large hedge funds, too. These guys have levered up massively on trades, and the banks are their counterparties. And if a couple of these hedge funds, the size of long-term capital management or larger, fail, like if it were to be revealed that Bridgewater or one of these other couple large hedge funds, Bridgewater has, I think, 300 billion, in assets under management. So if it were to be revealed that Bridgewater has an enormous repo exposure, let's say they have a large chunk of their total capital is involved in borrowing on repo and bad leverage bets on bonds, that could take out a bank with it because the bank would be the counterparty and Bridgewater might not be able to pay back some of the loans. The problem, Rob, is that a lot of things correlate now because of what the central banks have been doing. It's not just the Fed, it's the European Central Bank, Bank of Japan, People's Bank of China. So assets that used to be uncorrelated or negatively correlated, that's not really the case anymore. You have a lot of positive correlations where if the central bank like the European Central Bank or the Bank of Japan and the Fed all announce quantitative easing or increases in their balance sheet expansion, where asset classes go up together. And in the past, that has not happened. Well, they do it with toxic sausage derivatives because of financial repression. Because everyone needs income and yield, and these collateralized loan obligations are offering higher yields than government bonds that are manipulated down in yield. So if you compare yield, you're taking more risk with a CLO, but as long as the CLO in the prime tranche of leveraged loans is paying out, you're making more yield than you are in government bonds. So that's why they do it. And then the hedge funds, of course, because they're hedge funds, even though they don't actually hedge, are going to make a one-way directional bet on these CLOs, and they're going to borrow money to leverage up their CLO trade so they can increase their returns even more. But when these CLOs predictably do stop paying out, and there's enough downgrades, and a lot of these CLOs go bad, those trades are going to blow up. The central banks have screwed up the correlations. They've distorted everything. All the large central banks. It's not just the Fed. It's the largest 5 or 6 central banks. Well, the Fed is a cartel. So it's a central bank, but it's a cartel, and it protects the large banks first and foremost. So if JP Morgan has a problem, if they have too many treasuries and they need cash, the Fed could soon announce a larger not QE program so that JP Morgan can unload their treasuries at a profit for more cash to the Fed. So JP Morgan gets more cash, JP Morgan gets a profit on their bond trade. Don't be surprised if that happens. Now, I'm not predicting a blow up like what Zoltan said, because I think Jim Bianco is right about this, that they're just they've gotten away with it so far with how much the repo market, how much they've increased the emergency liquidity into repo. So the Fed's just going to continue this. The size of the emergency liquidity injections in the repo, the average person, the average regular person who doesn't care as long as their stock portfolio, their index funds are going up, or the average person who watches Bloomberg or CNBC, they're not going to question if the Fed's if the 14-day term repos are all rolling off the balance sheet, or they perpetually roll over, or if those 14-day term repos are rolled over into 28-day term repos, or the 14-day term repos are continually rolled over or rolled over into 42-day term repos. They're not going to care about this stuff. They're only going to care if something fails. So the average person doesn't question the system. Well, they say they hate capitalism, even though this is not capitalism that's going on, because no firms are being allowed to fail. No large firms, anyway. Well, that's what the Chinese government wants. 5G totalitarian human control grid system in place. They're using China as an experiment ground for a lot of the stuff. December 15th? I don't know. Trump wants a deal. The people who are advising Trump, Kyle Bass, they want the tariffs increased. I haven't read USMCA, I'm sorry. This shows, let's just keep it on the repo stuff. So I will attach links to to the 2 Ray Dalio and Bridgewater articles. Also is the Reuters summary talking about the forward dollar swaps from that's summarized in the Bank of International Settlements report, that's some interesting stuff, because those currency derivatives, because there is a global dollar shortage, because there's been so much dollar denominated debt borrowed in the last 10 years, that because a lot of these entities could not pay back the dollars, they then took out derivatives to get themselves dollars with the forward dollar swaps, hoping that the dollar would eventually start to weaken so they could pay back in cheaper dollars later. Pay back their derivatives bets. So they get the dollars, the forward dollar swaps, they get the dollars now, and they don't pay that much for borrowing, and they're hoping that they could pay back the loan later when their own currency rises against the dollar and the dollar falls. Yeah, I've talked about that. I've talked about Kyle Bass and the Chinese banks. No, China can't print dollars. The US government would stop that stuff. The US government would issue a press release saying that China's counterfeiting all these things. And then they wouldn't allow that. China can print as much RMB as they want. China can't get away with printing unlimited dollars. Well, Rob, they also have to sell that the stock market, that the U.S. economy is doing very well. There's not going to be a recession because the Fed uninverted the yield curve now. So there's not going to be a recession. The jobs numbers were good. In air quotes, were good. And yes, you're correct. There is a lot of people late on their auto loans. Yeah, but Drexlev, the U.S. doesn't need Saudi Arabia to buy U.S. Treasuries, or doesn't need their oil, because the U.S. is subsidizing shale oil. So they don't need to import as much oil if they're subsidizing shale oil. Shale oil is subsidized. Most of it's totally uneconomic. So their plan seems to be to subsidize shale oil. Okay, well, that's it for tonight. My voice is starting to go. I want to thank people who tip me in the super chat. I think there's 1, 2, 3, 4 or 5. And also to my over 200 Patreon account contributors. Hopefully there will be 300 in less than 12 months. 300 would make my life a lot easier. We're growing very, very rapidly. Also to my dozen or so monthly PayPal contributors. Much appreciated. To be able to throw me a tip once in a while, so I can focus on quality content like this and spending my time looking as sometimes a financial detective to connect the dots. So if there is a long-term capital management blow up, it may be related to the risk parity trade and also potentially Bridgewater, because Bridgewater is starting to hemorrhage on losses. Money is starting to pull out. The co-CEO Bridgewater just left. And after she negotiated a partnership with the Bank of New York Mellon, which has rapidly grown its tri-party repo custodian market from zero in the last 3 years to $100 billion per month. So I think there's more than just circumstantial or anecdotal evidence there. Be interesting to see if any of that stuff is declared on the 13Fs for Bridgewater. Analysis on transport sector. Yes, the semi-truck sales are bad. That's a leading economic indicator. I mean, FedEx has had really, really bad guidance and earnings for quarters now. So that's about the global economy. I mean, goods are not... There's a lot of leading economic indicators that are not doing well in the global economy. The moving of goods with rail and cargo containers and semi-trucks. I mean, all those things are negative. And yet here you have a blowout jobs number. But 40,000 of those jobs were, in my opinion, recounted from General Motors. So they should not have been recounted again, because those people didn't... new jobs weren't created. Those were just workers on strike. They were still employed. They were just on strike. But they were counted anyway. And no one brought that up on Bubble Vision.